Good day everyone. Today, our group will be presenting an analysis of corporate financial performance based on a 5-year trend analysis of AEON Group Malaysia Berhad, covering the period from 2020 to 2024. This presentation is prepared for the course Financial Management. The objective of this analysis is to evaluate AEON's financial performance by examining key financial ratios, including liquidity, leverage, activity, profitability, and market ratios. Through this analysis, we aim to assess the company's financial strengths, identify weaknesses, and provide recommendations for future improvement. Before we begin, we would like to introduce our group members who dedicated their efforts to completing this group project. Introduction and company background. AEON Group Malaysia.
Okay, this is view of AEON Group Malaysia, focusing on its background and roles in the retail industry. AEON Group Malaysia is one of the leading retail company in the country and is part of the AEON Group from Japan. As well-established global retail organization, AEON first entered the Malaysia market in 1984, and since then it has grown steadily to become a trusted household name. The company operates a wide network of AEON Mall, AEON Store, and AEON Max Value Supermarket, offering a wide range of products including groceries, fashion, household items, and lifestyle service. AEON is well known as providing quality product at affordable price while emphasizing customer satisfaction. AEON Group Malaysia is one of the largest and most diversified retailers in the country. It operates across retail store, shopping malls, supermarket, wellness, and financial services, competing in the highly competitive retail environment. AEON's key strengths include its diversified business model, ongoing digital transformation, and strong focus on social responsibility. However, the company also faced challenges such as intense market competition and maintaining a strong market position. AEON Malaysia as our selected company. AEON was chosen for its strong market presence, consistent financial performance, and status as a public listed company on Bursa Malaysia. AEON is a major retail operator in Malaysia. Its core activity include department store, shopping malls, AEON hypermarket, wellness outlet, and financial service, making it a key player in the Malaysia retail industry.
Liquidity ratio.
For the current ratio, it increased from 0.35 to 0.69 from 2020 to 2024. However, it is still below the benchmark of 1.0, which show weak liquidity. The current ratio of AEON Group Malaysia Berhad from 2020 to 2024 remains below the ideal benchmark of 2 to 1. This shows that the company has weak short-term liquidity. Although there was a small improvement over the year, AEON still depends a lot of inventory and cash inflow to pay short-term debt. This situation may affect the company's ability to settle short-term liabilities smoothly. One way AEON can improve is by better working capital management, such as improving cash flow forecasting. Next, I will explain the quick ratio. It improved from 0.08 to 0.30, but this value is still low. This means AEON has low liquid asset excluding inventory. The quick ratio of AEON Group Malaysia Berhad from 2020 to 2024 remained below 1. This means the company has limited liquid asset excluding inventory. This shows that AEON may face difficulty paying immediately liability without selling inventory. Even though there were small improvement, liquidity risks still exist. AEON may improve this by increasing cash reserve and collecting receivable faster.
Leverage ratio.
Hello everyone, my name is Adilla. Today I will present about the leverage ratio focusing on the debt ratio of AEON Group Malaysia Berhad. The debt ratio shows the proportion of total assets financed by liabilities. A higher debt ratio means higher reliance on debt, while a lower ratio indicates stronger financial stabilities. Based on the data from 2020 to 2024, AEON debt ratio shows an overall decreasing trend. In 2020, the debt ratio was 72.58%, indicating a high dependence on debt financings. This ratio gradually declined to 70.27% in 2021. 66.70% in 2022 and reached its lowest point at 64.41% in 2023. In 2024, the debt ratio slightly increased 65.62%, but it remains significantly lower in 2020. Overall, the debt ratio declined from 72.58% to 65.62%, showing that Aeon has reduced its reliance on debt over the time. These reductions indicate lower financial risk, a more stable capital structure, and improved long-term financial strength. In conclusion, Aeon decreasing debt ratio reflect better financial management. The company should continue to manage its debt carefully while supporting sustainable growth in the future. Next, we focus on the debt to equity ratio of Aeon Group Malaysia Berhad. The debt to equity ratio measures the level of debt relative to shareholder equity. A higher ratio means the company relies more on debt, while a lower ratio indicates a stronger equity position. Based on the data from 2020 to 2024, Aeon debts to equity ratio shows an overall declining trend. In 2020, the ratio was 2.65 times, indicate a high reliance on debts compared to equity. The ratio decreased to 2.36 in 2021 and further declined to 2.00 in 2022, showing improved capital structure. In 2023, the ratio reached its lowest level at 1.81 times, reflecting a stronger equity positions. In 2024, the ratio slightly increased to 1.91, but it remains significantly lower than in 2020. Overall, the debt to equity ratio was reduced from 2.65 to 1.91. This indicates that Aeon has reduced its dependence on the debt financing and strengthened its equity base. As a result, leverage risk is lower compared to earlier years and long-term financial stability has improved. In conclusion, Aeon declining debt to equity ratio reflect a healthier capital structure. The company should continue balancing debt and equity to support sustainability growth.
Activity ratio.
Hello everyone, my name is Zakia. I will present to you about the activities ratios, which is the inventory turnover ratios. The inventory turnover ratios increased from 0.78 to 1.18 times, which is the best performance in 2023. This shows a better inventory management. The inventory turnover ratios from 2020 to 2024 shows a gradual improvement. This means Aeons is selling inventory faster than before. Good inventory management helps to reduce holding costs and improve cash flows. Aeon should continue optimizing inventory management to improve the efficiency. Next, I will present about total asset turnover ratios of Aeon's group, Malaysia Berhad. From 2020 to 2024, Aeon remains stable by keeping it between 0.47 and 0.57 times. This shows that Aeon uses its assets consistently to generate sales but not very efficiently. Overall, asset utilization is stable, but there is still room for improvement. Aeon can improve this by using asset more effectively to increase sales.
Profit ratio.
Hi, I'm Shahira Afifah. To begin the financial review, let's look at the net profit margin, which measure how effectively Aeon convert their sales into actual profit. So this slide illustrates Aeon's net profit margin, which track the company's ability to generate profit from its total sales. In 2020, the margin stood at 1.02%, but it has since followed a steady upward trajectory, reaching 3% by 2024. So this growth indicates that Aeon has successfully implemented improved cost control measure over the 5-year period. So the data suggests that operational performance has strengthened, leading to a robust improvement in overall profitability and more efficient returns for shareholders. Moving to return on asset, this metric evaluates how efficiently Aeon utilizes its asset to generate earnings. So the ROA has a significant increase, rising from 0.66 in 2020 to 2.27 in 2024. So the upward trend reflects a more effective utilization of asset and a rise in management efficiency during this time frame. This figure confirms that Aeon assets are generating higher return, contributing to stronger operational efficiency and improve financial health for the organization. So finally, the return on equity slide measure the return generated on shareholder fund. So Aeon began 2020 with an ROE of 2.46%, which grew substantially to reach 6.61 by 2024. So the data shows that Aeon has significantly improved the use of shareholder fund to drive financial performance. So despite a minor fluctuation between 2022 to 2023, the final figure of 6.61 reflects a strong increase in shareholder value and highlight Aeon overall trajectory toward better cost control and operational excellence.
Market ratio.
Hello everyone, my name is Nurul Binti Ismail. So lastly, I will explain the market ratio, which is earning per share. The earning per share or EPS increased from 2.95 cents to 9.12 cents. This shows consistent earning growth. Higher EPS means increased shareholder value and is a positive signal to investors. The earnings per share of Aeon Group Malaysia Berhad from 2020 to 2024 increased steadily. This shows improved profitability and better returns for shareholders. Rising EPS improve investor interest and market confidence. Aeon should continue focusing on long-term shareholder value creation.
Evaluation of overall.
This slide summarizes the overall financial evaluation of the company by looking at liquidity, leverage, efficiency, profitability, and market performance. First, liquidity position. Although there has been some improvement, liquidity remains weak. Both liquidity ratios are still below the 1.0 benchmark, which means the company may face challenges meeting short-term obligations. The company is highly dependent on inventory turnover and cash inflow, so short-term financial risk still exists. Next, leverage and solvency. On a positive note, debt levels has been reduced, which lower financial risk. The capital structure is now more balanced and this strengthens the company's long-term solvency. This indicates better financial stability compared to previous period. Moving on the efficiency and asset utilization, inventory efficiency has improved and showing better stock management. Asset utilization remains stable, while operation efficiency is moderate but showing signs of improvement. Overall, efficiency is moving in the right direction. Now, profitability performance. All profitability ratios show strong upward trends. This suggests that cost management has improved and the company is generating stronger profits. Profitability growth reflects better operational control and revenue performance. In terms of market performance, EPS shows steady growth and shareholder returns have increased. This indicates rising market confidence in the company and a positive perception from investors. So finally, looking at the overall implication, investors benefit from higher ROE and EPS leading to improved returns. Creditors gain confidence due to lower leverage and reduced financial risk. Management can use these ratios to guide better operational and strategic decisions. The market views the company as more financially stable, supporting long-term growth. In conclusion, while liquidity remains a concern in the short term, the company shows strong improvement in profitability, solvency, and market performance, indicating a positive overall financial outlook.
Recommendations for management.
This slide outlines key recommendations to strengthen the company financial positions. First, to improve the liquidities, the company should strengthen the working capital management and enhance the cash flow monitoring to better meet the short-term obligations. Second, debt level should be reduced by gradually lowering borrowings while maintaining a balanced capital structures, which will further reduce the financial. Third, inventory management need to be optimized by improving inventory turnovers and reducing excess stock to free up cash. Fourth, to control costs and grow revenues, strict cost control measures should be maintained, while expanding higher margin revenue sources to improve profitability. Finally, to enhance the shareholder value, the company should focus on sustainable long-term growth and increasing the investor confidence. Overall, these strategies aim to improve the liquidities and strengthens the financial stabilities. It also enhance the operational efficiencies and support long-term value creations.
Aeon Group Malaysia Berhad has demonstrated a consistent upward trend in both revenue and profitability from 2020 to 2024. This growth has been driven by improved net profit margin, earning per share, showcasing better cost management and enhanced operational performance. While Aeon continues to demonstrate strong financial performance, there are opportunities for improvement, especially in managing its liquidity. The company's overall positive performance continues to instill confidence among investors, but to ensure sustained growth and stability, strengthening working capital management is essential. One key for improvement is cash flow forecasting to better anticipate future liquidity needs. Additionally, optimizing inventory levels could free up cash that is currently tied up in stock, thus improving liquidity without compromising operational
Thank you for
efficiency.
listening.